This conference will now be recorded.
Hey, Jorge.
Hey, how are you?
Good, how are you?
Doing well?
What's going on?
Getting ready.
Yeah.
No, nothing new. Same stuff, same stuff. So,
Yeah. A day full of the grind.
yep.
Yeah.
So how many people are you expecting?
Anywhere between just you and 3 or 4.
Well, I'm here. I'm here to support my friend, to
No big
learn.
deal. You know, that's what they're designed to be. They're not supposed to be big events, you know.
Yeah, it's not a massive event. I agree. Yeah.
I saw a
But
few registrations, but it seems like people register and they forget or they don't
they
show up.
forget. Yeah, that's right. Yeah, that happens all the time. Yeah. But
So
it's good.
it's okay. It's we've had some pretty good conversations. I've had, one person show up when it's an hour and a half conversation. I've had 5 people, and it leads to conversations I didn't expect, but so it's good.
No, it's always good. It's a good showcase for you, and it's always good to learn from you also, no? So yeah, it's good.
Yeah.
It's a two-way street, absolutely.
So yeah, it's 9 o'clock. I'm just gonna intro here and see if anybody hops in. It's let's see, July 14th, and this is the monthly coffee chat for those who can make it. This is being recorded. So we record all these events just for people that can't make them. They'll be posted online on our YouTube channel and our website. So welcome. So Jorge, I want to make sure I answered your question the other night. That was one of the things I was going to talk about.
Mm-hmm.
Just to reiterate, when people need access to funds, and I think we've all been there at some point, of how best to do that or what is available given the type of account you have. So that was going to be, I always have kind of a grab bag of questions prepared that people have asked recently in case
Mm-hmm.
nobody has questions, but so that was one of them. But before we do that, did you have any other things you wanted to talk about today, or?
No, if you can talk about that, that will be very good. Yes.
Okay. So, morning, Frank. Frank from the cabin in Wisconsin. Good to see your smiley face, Frank.
Seems that you're having fun, Frank.
That's
Yeah.
crooked.
So yeah, we can talk about that here briefly. I think you understand it, but I think for other people that listen to the recording or hop on, they might want to understand. So typically in the investment world, you have kind of 2 or 3 type of buckets. Two of which are retirement. So you might have a 401k plan, you might have an IRA, and then the other investment bucket generally is just a regular investment account. So frequently, if people are needing money, they're going to look where most of their money essentially is, and that's usually in their retirement bucket. So for you and others, that's usually the 401k plan. So if you need to tap into your 401k, there's generally 2 ways you can do that. One is via a distribution, depending on the specific plan rule. So your employer, when they design the plan, they have in the plan document how you can take distributions, at what point, and in what form, and how much. So there's a whole potential list of variables there, depending on the employer. Some make them very restrictive, some make them less restrictive. It just depends. And then, of course, it depends on whether you're still employed or you're not. If you're not employed, you generally have more liberty to do different things while you're employed, and especially when you're under 59 and a half, it's really restricted to take distributions. So we always defer people back to that plan administrator to see what the specific rules are. because that's really the quote unquote Bible of the rules. Now there's IRS rules that kind of sidecar to the plan rules, but you know, that's where you always want to start, is the plan document, and only the administrator really would have that. So distribution is the one way to access that, but you have to keep in mind, obviously, anything that you take out is going to be taxable as ordinary income. And if you're under 59.5, you're going to have a 10% excise penalty. Now, there are exceptions to those rules. We don't need to get into all of them right now, but if you have attained the age of 55 and separated service from that particular employer, that 10% would be waived. So for you, Jorge, I believe that would apply if you were to take a taxable distribution. Okay.
Okay.
The other option is the loan provision. I think this is where people get confused. I think we may even talked about it on this call before, but a loan provision, really, if the plan allows it, again, you have to check the plan document. They'll have the rules surrounding if loans are available and what that looks like. But generally, you can only borrow up to 50% of the account with a maximum cap at $50,000 per 12-month rolling period, is the general rule. And the reason they allow you to do this, now that 50,000 is not taxable, or whatever that loan amount is not taxable. And the reason that is because the loan provision states that you have to pay it back plus interest to yourself. And that's almost always going to be done through payroll deduction. So while you're employed with that particular company, and if you were to take a loan while you're employed and you have payroll deduction and they allow for a loan, then that's how it would work. You pay it back. Now, if you're not employed, I would say I've only seen this once or twice with some really goofy situations where people that are no longer employed could have a loan and pay it back, not to payroll deduction. So, but that's a very rare event. So for you to take a loan on your 401k is probably not going to be an issue or allowed because you're no longer employed. Okay.
Does that apply also to Iras or no?
That's a great question. So that's where I'm segueing to. Iras are a totally different animal. You can't take a loan from an IRA. So anything you have to, there's no provision. I think the IRS doesn't even allow it. So the only way you can access money from an IRA is really to take that taxable distribution.
Okay.
So then the taxable distribution, you have a little bit more leniency typically, how you do it, how much, that sort of thing. The taxation is going to be the same. However, you don't get that exception at 55 that you would in a 401k plan. So that's kind of a pitfall. If somebody were to roll over their 401k to an IRA, then take the distribution, they might miss out on that exemption. So if somebody's really needing the money, then you want to take it out of the 401k plan. Does that make sense?
Mm-hmm. Okay.
So always go back and talk to the administrator. That sometimes is the HR department, sometimes it's the actual company, Fidelity or Vanguard or whomever actually is the sponsor of that particular, or the investment firm that manages it. Go back to them to see what the plan document. Correct me if I'm wrong, Frank. I think you said your plan with Caterpillar, just as by example, if you were to take distributions from that plan, you had to do it pro rata, right? You couldn't select the investments. Did you tell me that one time?
I think I can't recall, to be actually honest with you, but they may have had some provision like that. They had some funny rules because the plan was one of the first ones initiated and then never got amended. So they had an after-tax provision and some other oddball vestiges of the 1960s.
Yeah. So sometimes what I was talking about, Jorge, and I may even mention this to you in the past, is say you have 10 investments in your 401k plan and you want to take a distribution. Well, the plan may dictate that you can't pick and choose which investment to sell off to provide that distribution. You actually have to take it across all of your investments, which on the surface doesn't seem so bad, for me, I'd rather have a little bit of flexibility, especially if something's really depressed in price. You know, you don't know the timing of it, right? So you could have a really depressed investment. I'd rather not spend from that. I'd rather sell off something that was maybe overvalued, like large cap or something. So it's more optimal. We might be splitting hairs, but I bring it up, you know, as illustration that, you know, employer plans are great because they subsidize most of the costs, but the trade-off is you have to play by their rules, you know. So having money in an IRA, whether it's self-directed or you have an advisor or whatever, generally has a lot more flexibility for you. So the IRA option is not a loan. You only can take a taxable distribution. And the one kind of saving grace or loophole there is that 60-day rollover rule, which we may have mentioned before. I think we talked about the other day, and that allows you to take the taxable distribution, and as long as you put it back in within that time frame, you do not pay those you don't pay those taxes. So they kind of give you that. Now you got to be careful. They only allow for that once every 12 months now, Frank, I believe is the rule. Yeah.
It's once every 365 calendar days.
Mm-hmm.
It's not one per year. In other words, you can't do it in December and then do it again the following January. It's got to be a 360.
Yeah.
It's one every what, Frank? Can you repeat that? Every year?
Yeah, no, once every 365 days, okay, you're allowed to do a rollover.
An indirect rollover, right?
Yeah.
Yeah. So this is called an indirect rollover. So you're actually, so say you were to roll over your 401k directly to an IRA and not touch the money, that would be a direct rollover. People do that all the time. An indirect rollover is when you actually take the money and then you put it back in. So you use the money. So in your case, if you were saying, hey, I need to float myself 20 grand until I solidify my employment, if you take that 20 grand and then you put it back within that 60 days, you don't pay taxes on it. So it's not the same as a loan, but it kind of is. You're loaning yourself that money and putting it back, but you have a very defined timeline. That type of rollover you can only do once every 365 days. And so that's a rolling 12 months, not the calendar year. So you couldn't do one now and then another one before the end of the year, or the one in 2022. You'd have to wait until July of next year.
And that's from a 401k to an IRA, right?
No, that's what we're talking about. If you were to do the indirect IRA.
Okay.
Yeah. Well, they did change it because there was an attorney. There was I can't remember. There was an attorney. He was doing rollovers every year, multiple times. You remember that case? I think that's what started this.
Holbrook was the guy's name.
Yeah. Can't remember what he was doing exactly.
Yeah, he was doing rolling 59-day loans to himself, and he did it over and over and over again. And it was really interesting. The IRS special publication actually had an example that was okay, but it wound up in a tax court, and they said no, the IRS publication is wrong. They went right by the legislation that authorizes rollovers from Congress, and basically wiped out his whole IRA.
Yeah. And then that's why this new rule has been up. Yeah. So anyway, I don't think a lot of people run into that scenario. You just got to be aware of the rules, but it is one kind of escape hatch if you need money and you want to avoid the taxes.
Okay, it's good to know. Yes.
The third option that I bring up to people occasionally, not very often, is that if you have another bucket of investments, obviously you can sell some of those off, and take the proceeds. There's going to be taxes there, potentially capital gain. Obviously, the money's not working for you, et cetera. So there's drawbacks there. In rare cases, you can actually use those as collateral for a loan. So there are institutions that will say, hey, you have $100,000 in securities, we'll loan you based on using that as collateral. So that's not optimal either, but even TD Ameritrade that we work with does have that. It has to be non-retirement funds, but in extreme cases or depending on the scenario, that's another option. And keep in mind, I didn't mention this before, but when you take a loan from a 401k, just as further edification of how this works, that isn't a loan against the 401k, it's actually a distribution. So say you take a $50,000 loan from the 401k, that money is actually being extracted. So it's no longer in the account. It's no longer invested until you get it back in. Could be 2, 3, 5 years, depending on the loan provision. So I think that's a misconception for a lot of people. They think they're borrowing against their 401k. They're actually borrowing the money. They're lending the money to themselves. It comes out of the account, then it goes back in. So there's an opportunity cost there of that money not working, but it's a better alternative typically than, well, not necessarily better, but if the other alternative is high interest, consumer debt somewhere, then that might be a better option, because the interest rate that you pay yourself back at least goes into the account and is generally at a lower rate. So just an FYI there.
Okay, good to know.
Another possibility, if you have a whole life insurance policy, some kind of permanent life insurance, you might be able to get a loan against the cash value of that. That's another alternative.
Yep. Did you get that, Jorge?
Yes, so I don't have I have a term insurance. I don't have a permanent life insurance, so that's not an option.
Okay. Then of course is, home equity. I think you've gone down that route, but just for other listeners, home equity, I think even financial planners kind of excluded from plans, which I think is a misstep. I think our homes are some of our biggest assets, right? So I think not considering the proper use of home equity may be a mistake, whether it's long-term planning, whether it's short-term needs, or some kind of combination. Frank and I have been banging our heads against the wall a little bit, talking about home equity, conversion mortgages. People have been brainwashed that they're really bad. The ugly word being reverse mortgage, people just think it's bad. But I think there's a time and place for reverse mortgages. I think there's time and place to tap into equity, HELOCs. I think you've explored that already, haven't you, Jorge, in your instance?
Yes, I already, last year I used my HELOC, yeah, so that's not an option for me, so yeah.
And then the last resort is your kids, right? So
yeah, I have been considering that too. That's another option. Yes.
If you don't mind sharing, or me sharing your son's little success.
No, that's okay. That's okay.
So your son is how old?
27.
27. So I don't know all the particulars. Maybe you could speak to it, but he had a little bit of GameStop. So he was one of the lucky few that had GameStop stock at the time that all happened, right? And then he cashed out.
He cashed out. He's a lucky gambler. Yes, he made it. Absolutely.
So he ended up with like 6 figures from that, didn't he?
Yep, that's correct. Yes, he made some money on that one. Yes.
That's good. Yeah. Well, I like success stories like that. So, but
well, it's not the best option, but yeah, he made some money there. No. Yeah.
So. All right. Well, I think I beat that dead horse. Does anybody have any other thoughts around that, Frank, about liquidity, accessing funds, that sort of thing?
No, I mean, I think you touched all the bases. The challenge when you're out of work is obviously your 401k money is not accessible to you unless you basically get it out of the plan. That's usually that door gets closed when your employment ends. The loan option.
Right. Okay. Is that helpful, Jorge?
Very helpful, guys. Very helpful. Yes, I appreciate the help.
Okay. Well, we don't have a lot of callers today, obviously, but I'm going to go through a few questions that we had, at least for the recording, or that I had. I also want to announce a couple things. Our theme this particular quarter, at least from our content, is more around behavioral finance, which I find pretty fascinating and important. So I think Frank's been pushing out a few articles on that already. So I'd recommend people check out the blog. In my, in my experience, what I've seen in terms of people being successful investors and just generally, sound financially, is they're strong from a technical standpoint, but they're also strong from a behavioral standpoint. And I think as advisors, that's where we really step in, is to make sure that investor behavior is appropriate, especially in bad years. So, but I think there's a lot to be learned there, that we call it kind of the soft side of finance. So I would encourage everybody to look at that. We can talk about investing methodology and taxes and so forth. That's the technical, harder side of finance, but the behavioral, softer side, I think, is probably equally important, because you can have all the knowledge in the world, but if you don't manage your emotions and your behaviors, you're likely to do the wrong thing at the wrong time. So thanks for doing that, Frank. What I've seen so far is good. So you got a couple more on the way, or how many are we doing?
Yeah, I'm gonna keep writing them as long as I can keep finding topics. I mean, I think you're absolutely right. Controlling your emotions is at least as important as your technical knowledge. And unfortunately, we're not trained to know our own human weaknesses. And there's nothing wrong with having the biases. You just have to make sure you take that into account when you make financial decisions.
Yeah, you need to be aware of it. We all have our own biases, and first is learning what they are and being aware of it, and then hopefully modifying that on your own. If not, that's why you hire somebody to help you do that. We also build in protocols, to kind of remove emotion. Perfect example is rebalancing. We haven't done it yet this quarter, but every quarter we systematically rebalance everybody's accounts. And that's regardless of what's going on in the economy. And I always explain to people, we do it for two reasons. One is to keep your risk reward kind of mandate in check, right? So you don't have that drift where, you're getting too heavy in equities or too heavy in bonds. So we're keeping that in check. And then two, it's that emotional component where we're shaving off profits at something from areas that are doing particularly well and buying into things lower, or kind of underperforming potentially. And that is usually, believe it or not, the opposite of what most people do. What do they want to do? They're like, oh, this has been a great fund or whatever last year, I'm going to keep adding to it. So things like that sound simple, but there's a reason we do it. And another illustration is when, we have deposits come in, somebody transfers their accounts or making deposits. Within reason, I try to invest it pretty immediately, and I don't sit on it and try to time it. So that's an emotional kind of control protocol for me and our organization, but also for investors. So anyway, that's good stuff. So we'll be looking for that. Maybe one of these, maybe next month, we'll get into more of the behavioral stuff. Let's see, what else came up? So this week, I think is kind of an interesting one, not interesting one, but fairly common. When I meet with new clients, one of the first questions I typically ask is, what are your expectations for rates of return? And most people shrug and they say, I really don't know, or they're way off the mark. I had a client in here the other day. They had met with another advisor, and they were really fixated on the rates of return that particular advisor had suggested. So there's two problems with that conversation in my mind. I just want to bring to light. One was, it was very investment rate of return centric. And what I try to articulate to the clients, who I think they got it, was that the rate of return by itself is fairly meaningless without a plan. And you can invest to invest and try to get the best returns, but it's not very meaningful if it's not connected to some kind of retirement or financial plan. So I always say you need to start with a plan the plan then kind of backfills into the type of portfolio you should have, thus the type of return you should be getting, right? So the goal in my mind is not trying to get the best absolute return all the time. It's really getting the return that you need to make the plan work. So that was kind of the first thing I always try to explain to people. The second is really just educating them on rates of return and what is an expectation. You know, what kind of expectation should you have? And Jorge, I'm going to put you on the spot. What do you think are good rates of return? You're a sharp guy. You probably get this right, but.
Well, depend on the investment and depend on the year and depend on the economy. There's a lot of things that you need to consider, no?
Well, let's say let's start. I always start with long term. So none of us on this call really know what the rate of return of stocks, bonds, or other asset classes in the next 6 months of the year really would be, or in the next 3 years or the 5 years. I think it's harder to come up with, right? And I think that most people would agree that rates of return in that time frame in the next 5 years, even 10, it's not going to be like the previous 10, right? So we could say that we're probably expected muted returns, right? So we probably all agree with that. But let's look at historical returns, like over a long period of time. What with the stock market, what do you think the average annual return has been?
I will say between 10 and 11%.
Okay, yeah, you're pretty close. Pretty close. It depends on what index you use and what time frame. I'm looking at a chart right now, and I usually use this as kind of a starting point. But if you look at the last 50 years, from 1970 through 2019, the average annual return was just north of 12%.
Mm-hmm. Yeah.
So when I kind of write this on the whiteboard when I'm meeting with people, and I say, so in my estimation, unless you get into something really leveraged, really extreme, you know, private equity like your own business, you know, something off the charts, really that should be the high point of what you should expect, you know, depending on how aggressive you are. And then I talked to them about, okay, of those 50 years, how many of those years do you think were positive versus negative?
I would say that probably 70% of the years are positive, around that number.
See, I knew you were a sharp guy. I need somebody else on this call. Yeah, actually 76% of those years were positive and the 24% were negative.
Right? Not bad.
Yeah, you were close. So, and actually, if you look at 94 years, they're pretty close. 25 years and different kind of. If you look at 1942 to 66, for instance, the rate of return was actually higher. The negative years was about 20%. If you look from 95 through 2019, that was pretty consistent with the 50 years. So when you start getting into 5 years and 10 years, you're going to have a greater deviation away from that. But the point being is I try to educate people and say, this is what I think the maximum you could expect if you were 100% equities, which you're not going to be. But I also want to make sure that you understand that statistically 1 out of 5 years, 4 or 5 years is going to be a negative year. It may not be the scary negative, but you need to prepare for that if you're going to be an investor. So I think that's good. I wanted to bring that up because that was a specific question that we were talking about this week, but people don't really know what to expect, you know, especially in a very good market. They just look at their statements and they see their accounts are up, but they don't have any idea what to benchmark that to or what expectations they should have. So.
No, it's important for them to know what's going to happen because some people they have no clue of what is going to happen to their money. No, absolutely.
Yeah. So we started using Riskalyze last year, the year before. Riskalyze is a software program that will quantify that for people. and it will take your portfolio and it'll actually categorize a risk number to that particular portfolio. So your 401k, for instance, Jorge, if you plugged it into that, it would assign it a number between 0 and 100, 100 being the most aggressive. But further than that, it will give you an in-depth kind of overview of the sector exposure, country exposure, so on and so forth, and then tell you within a 95% probability of what will happen to that type of mixture or that score in the next 6 months. They'll tell you the upside and the downside. And then it also will stress test it and tell you what that number or that type of mixture did in 07, 08, what it's done in good markets, bad markets. So you really get a visual depiction and a conversation about, what does this really look like? Because otherwise it's just way too conceptual, So you're right. They don't, and I always joke with people, it's like, you don't know how you're going to behave, back to the behavioral side of things, until it happens. But we're going to talk about it and prepare you as much as we can, So you get somebody in here that says, oh yeah, I'm pretty aggressive, I'm happy to do that. Well, they've never been through a bad market, so
Right.
That changes quite a bit when they see a negative 20% or something like that.
We are always very aggressive until you see a drop of 20, 25%, and says, well, maybe I'm not so aggressive, no? Yeah.
What did Mike Tyson say? Everybody's tough until they get punched in the face or something like that.
Everyone has a plan until they get punched in the nose.
Right. It's kind of the same thing, right?
It's the same thing, yeah.
Well, Frank's been around longer than me, obviously. So he was, I think, what's your story with 86, 87? Didn't you invest like that day or something right before it? Or I thought you had a story around that.
Not that I can recall, but I think your point is very well taken about you don't really know how you're going to behave until it happens. And that's the real weakness of all these risk questionnaires is you can answer the questions till you're blue in the face, but you don't know how you're going to behave until it happens.
Right.
And that's when you really learn about yourself. And again, getting back to that behavioral, it's how well can you control the urge to do something irrational.
Right. And if not, you need to pick up the phone, right? So, okay. The other thing that came up this week a little bit was I evaluated a Merrill Lynch account for somebody, and I just want to revisit fees with people. There's generally three types of fees that you need to look for. One is the management fee by the advisor. One is anything by the custodian or the brokerage. And then the third part that's most often overlooked is the expense of the underlying investment. So this was actually for somebody in Michigan, and they thought that the fees and everything were in line, and they just wanted me to take a look at it. I said I'd be happy to. And he said, I think I'm paying about 1%. Well, once we really analyzed everything, the underlying investments, some of them were north of 1%, and some of them were a little bit lower. I think on average it came to about 0.85 of 1%. And then they also had a variable annuity in there in one of their IRAs, and that was north of 2%. So obviously to the client, they weren't aware of this, and it was news to them. So I always like to bring that up when you're evaluating your portfolio, regardless of where it is. There's generally those three expenses that you need to be aware of. Now, you might think, well, 0.75, 0.85 isn't a lot, but when you add it on to the other fees, they're paying 1% for the portfolio, which is north of $1 million. So it should have gone down after that, but they didn't have any break points. But they were paying 1% there, plus the 0.85 on the underlying investments. So you're at 1.85 alone. Some people think still that's not a lot, but that's a drag, right? That's a big drag on your investment performance. So it's back to what we were talking about, return expectations. Return expectations at 12 is the high point, but you add bonds and other asset classes to the portfolio, so maybe you're now in the 6 to 8 range. Well, if almost 2% is going to the cost and fees, and then you have inflation at another 2%, you're barely making it, you're barely outpacing inflation at that point. So I just like to remind people about that. And for you, Jorge, that's the benefit of having your money in the 401k. You don't pay most of those costs, but the underlying investments you just need to be aware of.
Of the extra fees, absolutely, yeah.
So that came up, and then the last one, and the last one's fairly common too, is all about insurable need. And do I need insurance? So I typically work with a lot of people in their 50s and 60s and beyond, and they have a lot of legacy kind of insurance policies. Kind of like you, Jorge, you have a term, you don't have whole life. But there gets to a point in my mind that you don't really have that risk that needs to be mitigated. Typically at that age, your kids are gone, you don't have dependents, that are really relying on your income. So the need for insurance as you get older becomes less and less. And I think the caveat to that is a couple things really. Is A, maybe you still want proceeds going to your spouse. That could be to pay off a mortgage or just as to supplement retirement. So I think that's a consideration. I think there's also charitable and estate planning considerations too. It all depends on the goal, right? But you could create an immediate estate by just having an insurance policy, so maybe not that you're protecting dependents, but maybe you're creating an estate by keeping that insurance policy in place. And then lastly, you can do that for charitable inclinations as well. So it all depends on their goals, but frequently people in their 50s and 60s don't really need insurance, and it's an extra cost that they probably don't need to keep incurring. So I like to just bring that up since that was a question this week. Any thoughts on that, guys?
Well, I would say people who are very wealthy may need insurance in their older age because of anticipated estate tax expenses, but that is a very, very small majority of the American population.
Well, that might change with new tax law, but we'll see.
We'll see.
We'll see what happens. The other thing that too, I think that you experienced with a family member last year or so is estate liquidity. If there's no liquidity in the estate and you need cash, whatever the case may be, that insurance policy could influx, cash into the estate. So say it's all property. I've seen people, there's an estate where it's all farmland or stuff that can't easily be sold, but they have administrative fees and taxes to pay. Well, where do they get cash? The insurance policy can do that as well. So I had one other thought, but I can't recall. Oh, I guess the other thing that I would say is a strategy people should consider, or not necessarily consider, but be aware of. And we've looked at this for a number of people, is that say you decide you don't need insurance and you're still continuing to pay premiums. You've been paying these premiums for a multitude of years and you hate to just let it go. There's a couple different options depending on the life insurance policy you have. One, you can actually go to market and sell your insurance policy. There's people out there that will actually buy them. They'll give you cash for the type of policy that you have. The other one is to consider, and this is really in the cash value kind of whole life type arena, not the term, but is to exchange that into some type of long-term care hybrid. As we know, that's one of the biggest risks in retirement, is that healthcare kind of event. So if you don't have long-term care and you have an old policy, life insurance policy you don't think you need, you can make that exchange so that you're not giving up the money that you spent to have that policy. And now you're getting long-term care coverage with not really more out of pocket expense to you. So just wanted to bring that up.
That's only for term, right? But that's only for whole life, not for term.
Correct. Yep.
And variable annuities. That's another one you can exchange. But yeah, that doesn't apply to term.
Okay.
Right. I guess that was it I had for questions this week. I think I was just going to bring up a recommendation. We're still kind of wrapping up some of our tax stuff. If you have tax returns that we haven't reviewed, please get them into us. That was a little light this year. But I just wanted to bring up a reminder that a few of the low-hanging deductions out there obviously are going to be your IRAs, your 401ks, so always look at that. We talked about a couple strategies the last couple of years. One is bunching your deductions. As you know, it's getting harder and harder to itemize and exceed the standard deduction. So one strategy is bunching some of your deductions every couple of years so that it puts you over the standard deduction and you can now itemize. So we've had a few people do that are already contributing to charity. If they're contributing to charity, right, every year, but they're not really getting an ancillary, economic benefit from that because they're not itemizing. One such strategy would be to do a lot more in 1 year, like every 3 years, you do a much larger amount. The charity is still getting the same, just at different times. And you at least get a benefit from the charitable deduction that you wouldn't normally get. So, and then that leads into the last point. One of my favorite kind of things in that strategy is using a donor advised fund. A donor advised fund allows you to get the current year charitable deduction, but you can then control when you make the distribution to your respective, charitable interests. So it gives a lot more flexibility. And then the caveat to that real quick, and if anybody wants to talk in more detail, I'm happy to do that. The caveat to that really is, yeah, I like giving money, but I don't want to give that much money away. And once I give that money, I can never have it back. There are instruments out there that allow you to at least get an income stream. So there's these instruments called pooled income funds that operate just like a donor advised fund. You can put money into it. You get the current year tax deduction. It goes to the charity of your choice, but then there's a mathematical equation to figure out an income stream that comes back to you. So that's kind of nice in the sense that you're not totally giving your money away. You're getting a tax benefit and an income stream from it at the same time. That's a little bit more palatable to people. But I've gone down the rabbit hole real quick. I just want to bring that up when you're looking at tax deductions, when we're talking about strategies to minimize tax in our tax analysis. Bunching is a pretty common one, bunching of deductions. You could do that with property taxes or just regular taxes. You could do that with charitable contributions, but that's usually most prevalent for the people that I've been working with. So I just spouted out a lot. Questions on that, Jorge, or anybody? Any thoughts?
No questions on this side. No.
Okay. Well, that's all I have today. Let me double check here. We talked about expected returns. So we will be having probably some type of event, probably 2 events coming up this summer. I hope to do an in-person event for clients. So look out for that. And then we'll probably have some kind of webinar this quarter. I just haven't scheduled that at this point. Everybody is traveling now that everybody's free. A lot of people are gone or busy in the summer, so it's good to see things opening up. Things are pretty open there now in LA, right, Jorge?
Everything is open now, but Delta is going up again. So who knows?
Yeah. I was reading that this morning. There's some hot spots for a lot of the unvaccinated areas.
Yeah.
For low vaccination rates. So, how about Wisconsin, Frank? Is it all back to normal there, pretty much, or?
Yeah, pretty much. As a matter of fact, there's a state of Wisconsin county by county website that it's updated every day, and I look at that every couple days out of curiosity. And in Barron County, which is where I'm at, there was one positive COVID case in the entire county last week. So it's either they're not getting tested or it seems to be receding.
That's good. That's good.
Yep.
And before I go, how's the fishing this year?
We had a fish fry last night.
Yeah.
It's been okay. It's off and on. You go out one time and catch. I went out a couple days ago and had 20 of them, and then I went out the next day and caught 2. So
Right.
it varies. It varies.
Well, you haven't got skunked then, have you? Any days?
Oh, I've been skunked a few times, but you usually catch 1 or 2. It's rare that you get 0, but it does happen.
Yeah. Yeah. Well, we should catch up soon. Let's get a call. I think you're coming back into town this month, aren't you? Sometime end of the month, or?
June 30th or July 30th, rather.
Okay. Okay. We'll probably catch up before then. It's been a while.
Okay. Yep.
All right, guys. Well, Jorge, thanks for coming in. Good luck with everything, and
Thank you, Todd. Thank you for all the help.
I'll talk to you. I think we'll be talking Thursday night, right?
On Thursday night, yeah, right.
Okay. All right, guys. Thanks so much for showing up, and we'll be talking to you guys both soon. All right.
Okay. Thank you, guys. Have a good week.
Thanks.
Have a good one.
Bye-bye.
Bye.